All right, everyone. Appreciate your patience this morning. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I'm a coach with Schwab. Delighted to be with you today. So today, what are we talking about? Well, we are going to talk about the fact that base hits can be a beautiful thing. Today, we're talking about making money. Specifically, we're going to talk about how a trader might consider using options to generate an income target. And so if you are new here, and I can see that we have a lot of new people with us, thank you so much for joining us today. We have a jam-packed agenda. A lot of you have been hanging out in the chat for the last 45 minutes or so, and it is great to see such an active chat. We have Connie Hill with us here in the chat as well. She's a friend and fellow coach, knows a ton about all the topics we are going to cover today. And I can't wait to see how things unfold. So, hello to AP514 and Wiley and Alina and Guy and Jim. And we have had people in here literally for 3/4 of an hour. So to Chad and Mojo and Ken and Dragon Rider and the rest of the gang, thank you all for helping bring this class to life. Love having you all here. If you have questions, don't hesitate to ask them in the chat, especially if you are new. And between Connie and I, we should have answers for you. If you're watching this in the archives, as thousands do, if you type your question in the comment section, or even if you just love the class, if you type that in, I respond to those comments on a daily basis. And the third way for me to be able to communicate with you and you with me is through the land of X or Twitter. And so I invite you to follow me on X, Connie as well. She's posting great stuff on a daily basis. Her handle is Connie Hill CS. For Charles Schwab, mine is at Barb Armstrong CS. So let's get right down to business. There's a few things that I just want to make sure that we cover. And one is that, when we talk about options, they do carry a high level of risk with some trading strategies, and one of which we're going to talk about today. We could use the entire amount that we pay to get into the trade. So we have to be aware of that. So options aren't suitable for all investors. If you want to trade options with Schwab, you have to apply for option trading privileges. Not all will qualify. We've got to take transaction fees into account as well on options. We use the paperMoney platform on thinkorswim. It is a brilliant place to learn, to hone your skills, to become familiar with how to use the platform, and and also how to become familiar with your trading strategies before you venture over to your live account if you decide to do that. There are some nuances and differences. One of the big ones is that a short option will never be assigned early in paperMoney, and that can happen in a live account. Know that past performance of a stock or security doesn't guarantee how it's going to move in the future. And know that when we use a stop loss, which we'll be doing some examples of today, we put in a target, it doesn't guarantee that we're necessarily going to get out at that price. So the topic is trading a smaller account. We started the year with $20,000. In fact, we started on November 1st. With 20,000. But, even someone with a smaller account, or some people might have a very large account and they want to actively trade a smaller portion of it. And so there's lots of questions coming in the chat. So I'm going to kind of focus on my agenda, and then I will pause every 10 minutes or so and have a look. And we've got Connie who's going to do her best to answer all these questions flooding in the chat. So we're going to start. I have one announcement to make. Then we're going to do a quick overview of what's going on in the markets. We have two existing trades that we want to manage. One is one that we're already out of. One is one that expires today. And then we're going to place some new example trades. Okay. And so here's the announcement. And I'm kind of excited about this one. And that is that starting, on the week of the 24th of February, starting the 26th, there is going to be a second trading a smaller account class. You guys have been asking for this in the surveys for years now. And so starting Monday the 26th, long options is going to be that long options time slot on Monday is now going to be trading a smaller account. So we'll have trading a smaller account at 10 a.m. Mountain, noon Eastern on Fridays, noon Eastern on Mondays, and then we have trading breakouts at 1 o'clock on Wednesdays that I treat as a companion class to this. So we'll get to meet 3 times a week, to kind of look at what's going on in the markets with our, small account. Now, long options, and I am such a huge advocate of mastering one strategy at a time. I get up on my pedestal on a regular basis and talk about that. That long options class is going to move to Thursdays, and it's going to be taught by Connie Hill. Okay, so long options, that class isn't going away, and we're still going to do, lots of long options trades in these 3 classes weekly, the breakouts on Wednesdays and trading a smaller account Monday and Friday. Okay, so this isn't just about options, and actually the first 2 trades that we are going to talk about involve both stocks and an option, and it's called a buy right. Okay. So, what do I mean by a base hit? I'm talking about what I mean by a base hit is a small win. And this account that we started at 20,000 on November 1st is now we're at 25,000. And so, we're up about 25% in the last 3 months. We're up about 25% in the last 3 months, November, December, January. Well, we're midway through February, so 3.5 months. And the idea is what I'm talking about with income. And this came about because I met someone in Dallas at the last in-person event that we did. And he was saying that he wanted to earn an income from his trading. And, he had some portion of his portfolio that he'd invested for the longer term, but he wanted to earn an income. And I said, how much do you want to make? His comment was, I want to make $100,000 a year. Now, I don't give financial advice, but, doing the math, it's like, okay, well, if you made $8,000 a month, that would get you to 96. I'm a big fan of good, great, and awesome goals. But if we want to make the math easy and we said, okay, if you want to make $8,000 a month, that gets you to 96,000 a year. That's 2,000 a week. So how are you going to earn 2,000 a week? And it's not that at the end of every week you may need, $2,000 that you can withdraw. But if that's kind of your overarching goal, some months you may be ahead, some months you may be behind, some months you may not, end up making anything. If you made $2,500 a week, that's $10,000 a month. That'd be $120,000 a year. Now, this is trading a smaller account. So maybe you take that and you say, well, what I want to earn is, $200 a month. Which is $50 a week, or I'd like to earn $100 a week. $100 a week over the course of a year is, 5,000. Well, 5,200 a year is, 5,000. 5,200. Which is we're already at that. And so, but if you set a goal and then you try and track to it, then you have something that you're aiming for. And when you're placing trades, and what I mean by a base hit is if something makes $200, are you saying, well, that's not that great. I'm not going to be drinking something out of, a coconut in Tahiti on making $200. No, but $200 represents 1% of our starting value. And if you can do that again and again and again, it starts to add up and look like, smell like, feel like real money. And this is our, a smaller, what we're calling a smaller account. For some people who have a larger account, their goals might be different. But what I'm suggesting is that you have a goal. And I just taught a class a couple of weeks ago in Getting Started with Options, which I teach on Tuesdays, which is the 7 things I wish I'd known about trading and trading options when I got started. And one of the very first one I mentioned was to have a goal. How will you know if you're achieving what you set out to achieve if you don't even know what you're aiming for? There is that quote, right? If you don't know where you're going, any road will do. And so we're going to look at some strategies today that can help us, earn, a little bit of money on an ongoing basis. And the first 2 are actually, I wouldn't say they're base hits as much as they're probably doubles or triples. Okay. So let's now look at kind of what's going on in the market in general. So this is the S&P 500. If I come to patterns in this little thing underneath patterns and say show price as a percentage, it'll show us that, in the last 3 months, the S&P is up 11%. How about the last year? Well, it's up 23%. This number in green represents where we are based on today. And so when we look at that, it's hard to characterize this as anything other than bullish, correct? Correct. And even though this morning this index started out a little down compared to where it was yesterday, we're now, up by a smidge, but certainly an uptrending index. The NASDAQ is our tech-heavy index. So this is our tech-heavy index, and it's up 43% in the last year. And and again, even though it's down just a little bit today, it has been uptrending pretty dramatically since the end of October. How about the Dow Jones? Well, the Dow 30, this is different from the other two indexes in that the value of this index, or the contribution of a stock on this index, is based on the price of the stock, not the market cap of that particular stock. But it too is up, and has been trending certainly since October, up 15% in the last year. And today it's just it appears to be kind of pausing and catching its breath. Steve is asking, when it comes to setting goals, do you want to do that as a finite number or as a percentage? And, it's your goal, so you can make it kind of whatever you want. Okay, and the Russell, it has been, and the Russell, it has been kind of in a rut, as I like to say, for the last couple of years, going sideways in a pretty big range. Like, this is about a 20% range, but it's up at the top of that range and then just recently broke through. And so, will it continue to stay above? And really, since, the middle of December, it's been kind of in the top half of this range. And, has broken above this. It's still trading above the 2-month mark, which many consider to be pretty positive. Okay. All right. So somebody is saying, rule 2 is don't trade over earnings. Actually, that wasn't my rule 2. And I will post a link down below in that Getting Started with Options, the 7 things I wish I'd known. But because we're going to do a couple of earnings trades, and that's a rare thing for us. But what we're going to do is put in some protection over earnings. And we talked about this in the Getting Started with Options series when we talked about protective puts. And so let me just finish this. The market overview. We talked about this in Getting Started with Options. So let me just finish this. Sectors have been leading. And when we look at the last month, communications, energy is coming back around the bend. Financials, industrials, and tech, are the top 5. What about over the last 3 months? Well, it's communications, financial, healthcare, and technology. And, if you want to be able to set up your watch list to look like this, I did a series of mini sessions. And so with these mini sessions, I talked about, and somebody asked about maybe how to set up the monitor tab, or I forget which one it was, but I created some mini sessions. And one of the reasons you'll want to subscribe to this channel, my friends, is because, this Trader Talks, and if you've already subscribed, don't hit the subscribe button again, or you'll unsubscribe. But you can come to playlists, and then all of these sessions, unless there's some kind of technical hiccup, they are archived. And so these mini sessions, and I think we're going to rebrand this and call it, the thinkorswim mini sessions. There's one on how to add a script. There's, one on the monitor tab, and no, scripts aren't guaranteed as to accuracy, or how to customize a watch list, how to customize a chart, how to use notes. And I've got several more that I'm going to add over the next week. But this is one of the things. And then if you want to come back and look at, say, the Getting Started with Options series, that's down. You can just scroll down, but they're all grouped. So here's getting started with options, and this, 7 things I wish I'd known. And really it's about trading in general. But that's how I closed out this series. In any event, you'll want to do that. The other thing, because we have so many new people here today, that I want to show you is, and I put a link in at the very top of the chat. There will be a link in the show notes down below also. But if you go to schwab.com/Schwab coaching, you can see all the webcasts. We are basically teaching webcasts from often before the market opens through the market close all day long. And we're doing live example trades so that we can take the concepts that you're learning and apply them live in the market. And then we're following up on those in upcoming webcasts. So this is our Trading a Smaller Account. And as you can see, there are 4 additional classes coming up today. Advanced charting, advanced options is coming up. This was the class on the 2nd, sorry. Let me come down to today. Today is the 16th. Yep. So, these are the classes coming up following this: advanced charting, options, how to create scripts, and getting started with stock investing by our own Connie. So you'll want to catch that. Okay, so those are 2 links, but, hitting subscribe and then, making sure you've got this. I've pinned those to the top of our feed also. Okay, also, if you are new to the platform of thinkorswim, you have the right to book an appointment. And you can book an appointment every 6 months with them if you like, to do a one-on-one with a thinkorswim specialist. And I posted that in the chat, and Connie will repost that as well. Okay, so let's get down to business. So I want to look at a trade that we had placed a couple of weeks ago on a firm. And on a firm, what we did was we bought 100 shares of the stock, and then at the same time we sold a call. And the goal was to get called out. Now, a firm has been on quite a tear, and we'll go and we'll look at the chart. But as of the end of today, this is going to expire worthless. So the stock is currently trading at $40.12. So we haven't, as of yesterday, we had kind of about broken even, but this is going to expire worthless. And then we could just exit the position, or we could choose to sell another call. Okay. So if we come to the charts, now my plan as of yesterday was to buy this back and sell another call. Now, if you're wondering why we might have done this, if we come back even 9 months on this one, you can see this stock, well, let me go to a year. This stock went from a low of $8.80, up to the $40 that it's trading at right now. It's up 195%, even though it's kind of pulled back and been going sideways. And this is a stock that is in the financial space. And financials, have been one of the leading sectors. So when we look at this, though, we sold this buy right. It's going to expire today. But do we want to sell another call when it's sitting at support? And to quote, an expression from a comedian that I've enjoyed over the years, John Panette, I say nay, nay. If we're thinking this support level, and it's come down here several times now, so this is our 4th time. If we wait for this to bounce, and if next week it goes up a little bit, could we sell that call and get more money for it? Well, that would be the plan. So we will look at this again next week. Okay. But for now, just know that this is going to expire worthless. And then the plan would be to buy another one. Okay. The volatility on this one is very high, which is part of what made it appealing. And how do we know that volatility is high? Because when we come here to the trade tab and we look at this number here, this is implied volatility, 78%, as opposed to a company like, say, Coca-Cola, KO, where the implied volatility is 13%. So what does that mean for us? Well, if I look at this $59 stock, if I sold the 60, they'd give me 51 cents for that, which is not very much, right? Like barely worth it. But if I look at a firm and we say, okay, it's trading at 40. If I sold the 41, they'd give me $2.60. Well, that's a whole lot more interesting, but there's more risk. You know, like it's saying here that the one standard deviation move here is $6 up or down. You know, so with great potential reward comes great risk. But if we could make that $260, would we consider that a base hit? And the answer is yes. We in the context of this class, like we're up $141, of which $319.50 of it has come from the selling of this call. Okay. Yeah. As somebody's saying, you know, I try and speak in plain English, and I really do try and avoid trader speak, but there is a language around the world of investing. And so, you know, support or the floor and ceiling, these are all kind of part of it. Okay, so let's go and look at another stock that's kind of higher on the volatility charts. AAOI. Now, why are we looking at AAOI? Well, could it be because this stock is up like 650%? It was down at $1.60 back in May of last year. And, you know, it's had a really nice run up, you know, kind of starting back here, you know, at the end of May, but certainly, you know, since the beginning of November, when the market in general started to move to the upside. And then it started to pull back, and we had this, what we call a diagonal resistance breakout. Now, you know, yesterday when I was looking at potential examples, you know, this looked, you know, made more sense. So today, where are we sitting? Well, we're down 31 cents. And, you know, it's been sitting kind of at this support level for a bit, and then it moved up. A lot of stocks we're seeing, you know, a bit of a pullback today. But if we bought this stock, if we thought that it might continue to go up, and when I did a bit of digging on AAOI, I found that earnings is coming up. And so if we come and we look at this, and so when we look at, like, here's volatility, like we thought 70% was high, this is 140%. So is this riskier? Yeah, it certainly is. And if we were to come out to March, like, you know, we have a recipe, if you will, or a trading plan for every type of strategy that we trade. And with a buy right, kind of one of the components, and every trading plan has a what to buy, when to buy, how much to buy, when to sell. But we wanted to trade over 1 million shares. And with this one, if we come out to March, that's over earnings. And if your rule is, well, we don't want to take that risk over earnings, but what if it gaps to the upside and then we'll have missed it? So we talked about, you know, a protective put using so we're going to buy 100 shares of stock. We are going to sell this, even if we sell this 25, and you know, it came really close to 25 today. So if we sell this 25, how much could we make? Yeah. So we're going to come out here, and on this platform, we don't call it a buy right, we call it covered stock, because we're buying the stock and we're selling a covered call. And so what's the most we can make on this if we are called out? Well, we could make the difference between what we're paying to get into the trade, which is $19.58, and the $25. And if we look at that and we say, okay, well, that's about $5.42 on a $19 investment. So our potential return on risk, because if we're risking something, we have to know, like, is it worth it? So our return on risk potentially, so I should put a P there, our potential return on risk is $5.42 on a $19.58 investment. So if this gapped up, let's say it went to $30, are you going to be crying in your cups because you made a return of $542 on an investment of $1,900? So if I look at 542 and I divide that by 1958, that's a 27.7% return. And in the context of our class, that's not a base hit. I think we'd call that a home run. Okay, but now what could we lose? Well, we could lose $1,958. But our guideline in this class is we don't want to move more than, risk more than 500. So how do we get around that? Like, how do we manage this risk? Well, we're going to come out back to the trade tab, and we're going to say, well, if I see this being a support level around this 1877, and I went, say, 3% below that, that would be around 1820. Remember I talked about, but what if it gapped down? Like, because if it could gap up, it could gap down. And we've seen we're in the middle of earnings season, so we've seen lots of gapping going on, haven't we? Yeah, we have. So we're going to come to the trade tab and we're going to say, okay, earnings is the 22nd. I only need coverage. I only really want coverage over earnings, and then I could put a stop back in place. But remember, with a stop, if it gaps down, we're not guaranteed to get out at the price we requested. But if we buy a put, it's different. Why is it different? It's different because we have the right at any time between the time we put the trade on and the time we exit the position. We have the right to get out. We have the right, and this gives us the right to sell the stock at this price. So if we said, okay, this bid-ask spread is 20 cents wide, we'd rather it be not quite so wide. But if I had to pay 90 cents to protect this at $18, I'm paying $19.55 to get in. I have the right to sell it now at 18. How much am I risking? Well, I'm risking 150, plus. So I think our potential return here, let me just write that down, is $548, $545. That's our potential return. And what I'm risking if I buy this put, let's say I have to pay the full 90 cents, I'm risking $1.53 plus 90. So I'm risking $2.43 to potentially make $5.45. So that's, better than a 2-to-1 risk reward ratio. So if we said, well, okay, how do we put that in? I like that question. Okay, so we're going to go in to single order, first trigger sequence. We are going to come up here and say that we want to buy. So I'm going to click on, it shows up really small, but when you hover over something, we want to buy. So we're buying 100 shares of stock, we're selling the call, and then we're buying a put that expires on the 23rd. Why not buy the put that expires on March 14th? Because we're concerned about protection over earnings. And so we're going to have to make a decision on what to do with this. Now, if the stock gaps up, what's going to happen to this put? It's going to be, it's likely going to expire the next day worthless. Or maybe we could, sell it and get a nickel or a dime back. But if this expires worthless because the stock gapped up, and if then we get called out, are we going to be doing the happy dance and be okay with this ending up worthless? Yes, we're going to be just fine. Okay, so confirm and send. Fire in the hole. This is called a buy right covered call. And it's a strategy I take a whole class to, go over. But this is one way, that we can generate income. And it doesn't recognize that we have got this put that we're buying here. It's saying we could lose 1,964, but we know that by buying this put and it giving us the right to sell the stock at 18, that we're chopping, down our max loss theoretically, and our max profit is 536. And I'm going to put a note, added a protective put to cover risk over earnings. Okay. This is just a note from us to us. Yes. Another word for this is a caller. Although often we will collar a position when we already own the stock. Today we're buying that. So this isn't a spread, but Miguel, I really like your question because we're going to go in and do a spread trade now. So we're going to look at a little company. It's actually not a little company. It's called Caterpillar. And wouldn't that just, it didn't come up. I was going to say, wouldn't that just frost your socks? Or frost your petunias is actually the expression I use most of the time. So there we go. So we bought our covered stock and we've also bought our put. Okay. So we can see that here's a stock that's come up from 233. In the last 6 months, it's up 17%. And it kind of, it has moved, pulled back, and is now moving again to the upside. So a technician might look at this as a bull flag, okay? Because and why would I say that? Well, let me just draw it. I don't know about you guys, but I'm a pretty visual person. So it came up, came back for one day, came up, back for a day. Came up, hit this intraday high, came back. And so we have this series of higher highs and higher lows, which is one of the things that helps define an uptrend. And then it came down, hit this, established a support level, and is moving to the upside. So if we are overall bullish on Caterpillar, and, I looked at it, just recently had earnings, and it beat on the earnings line. I think it missed by a little bit on revenues, but one of the analysts has raised their price target on this stock to 385. And there's another one that has the price target at like 325, which is basically where it's sitting right now. So it's not unusual to see a pretty wide range. But if we looked at this and said, might we think that this stock could end up above, say, 325 or 330? It just recently hit 334. But this is an expensive option. It's an expensive stock. Chances are the options are going to be pretty expensive. So if we come out and we no longer need 30 strikes and we come back to our 10, if we come out here to March, we can see that these are $10 wide. And, to buy the strike closest to where it's currently trading, it's going to cost us either $620 or $1,130. Well, that's too much money for us. We don't want to risk $1,100. We don't want to risk over $500. And so, could we do this as a long vertical? And we could, or might we want to look at a weekly option? And why would we want to do that? Well, does it trade over 1 million shares a day? And I did do an example trading plan for this strategy also, and I'll post that in the notes down below. It's in the long options class, or the long vertical class that I was teaching back in November. But when we look at this, could we do a 320 and a 325? Now, it's gone up a bit. So it would only have to move up $1. So if we look at, this is called a long call vertical. So could we do a long vertical? And it's at 283. And our guideline in this class is if we can make 50% on this, we're really happy. Now, how much could we make? if you don't want to do the math yourself, we could lose 283. The most we can make is 217. So if we said, well, 283 times 1.5, we'd be getting out and leaving 75 cents a share or $75 on the table. But if we could make a 50% return on a trade we might only be in for 3 weeks, would we be okay with that? And if your answer is yes, then away you go. Okay, so we are going to put in an exit. Now, the downside is if this trade does not go according to plan and we're down 50%, we're going to exit. So we're going to create an opposite order and we're going to get out at $4.24, which would be a 50% return. Now, if it gets up to the point where maybe we're up and we're up 415 and it looks like it's going to roll over, we might want to, exit the position. So it doesn't mean we have to wait until it makes 50% or loses 50%. And one of the things that we might want to do once we've put this in, and you might be saying, hey, how come you aren't putting in an OCO order to get out? And it's because sometimes there's volatility when the market first opens. And I've seen in my live account, me end up thrown out of a trade for a way bigger than a 50% loss. And then the market settles down and I wouldn't have ended up out at all. And so this is why we want to manage these. Now, here's an example of a trade that we ended up out of yesterday, and it was on Alta. And on Alta, if we go back 30 days, we placed this trade on February 7th. So we actually only had to go back. So we got in, we paid $265. How much could we have lost? $265 times 2. So we could have lost $530. And yesterday we got out for $5, which is the max gain on this thing. How often does this happen when we still have weeks to go? We're still middle of February. We still have a month to go. Well, it was, you notice when this got filled, 731 Mountain. And so we were able to take advantage of this little hiccup when the market first opened, and we might not have been out of this trade otherwise, right? So we took advantage of that volatility, and we're willing to do that, because we ended up making how much on this? We ended up making $2.35. If I just subtract the $5 from the 265, we made 235 on a risk of 265. And so that gave us a return on our risk of like 88%. Now our goal was 50. So this ended up kind of gapping up above what our goal was. And you know what? We'll take it. But we'd rather avoid taking it the other way. Now, what's the downside? And I'm going to show you the downside in just a sec as we wrap this up. But on this one, we ended up making $470. And, in our class, we wouldn't call that a base hit. We'd call that a double. Like a base hit is 150 or 200. So we'd call this maybe a double or a triple. You'd almost think I was a baseball fan, wouldn't you? Yeah. I'm more of a football fan, actually, but, I like the baseball analogies. Okay, so let's look at the downside. So the downside, upside was I took last week off, and I was in New York and having fun catching plays and doing things with my friends. But I wasn't managing my positions in this paperMoney account. And so now we're taking a 99% loss. This is expiring today, and we're going to lose 100% of what we could have lost. Yeah, the cat trade, I did put that in. Okay, so now you see, I was willing to pay $283 for that. Do you see that? And it's now trading at $287. So if we want to make sure that gets filled, we're going to cancel and replace. Say, you know what? I'll give you $290. There we go. 291, and we'll see if we get it filled. Just, we want to make sure that we get that filled. So with Micron, okay. So with Micron, I didn't do what I was supposed to do and exit. So we took twice the loss we should have. And so that just, took half of our gain that we just made on the 470. And so you do want to, but how long does it take for us to look at this and say, hey, you know what, we're down 2%, so we're just going to let that roll. I think we just put that on in the last day or so. We're up a smidge on Amazon. We're down 30% on Microsoft. So Microsoft we might want to look at and then decide, do we want to stay in this or not? And it's just kind of going sideways. So we're going to just roll with it. But, we could look at that again. We'll look at that again probably. I will look at this daily, now that I'm back. Yeah, there's somebody saying, ouch, and you're right, that is an ouch. So what have we done today? Well, we've talked about ways that we can use options to earn an income and while managing our risk. This is recorded. We placed 3 trades. So we did a trade on AAOI, I forget the name of the company, Applied Electronic. I've looked at this stock a lot. So we did a buy right on this with a protective put to give us coverage over earnings if it were to gap down. And we realized we could lose 100% of what we paid for this put. We also did a long call vertical on Caterpillar, which is another, I call that a potential base hit. How much are we risking on that one? $290. We also looked at a firm which we own as a stock and will look to sell another covered call on in our class next week. So here's what I ask of you. 1, if you would do me a favor and hit the like button. 1, it lets us know that you found this content valuable. 2, it helps move this stuff up in the YouTube land algorithm so that more people can find this content. And then the third thing is it's a chance for you to do a random favor for a stranger that without leaving the house. Next thing, if you haven't already subscribed, in which case, if you have subscribed, stay away from the button. But if you haven't, you want to hit that button, because even if this class wasn't the ideal class for you, if you're interested in learning more about the world of investing and trading, my guess is there is a class there for you. And if you hit subscribe, it's free to join. And then, you won't be like the woman that reached out to me and said, I saw one of your webcasts 3 months ago and then couldn't remember your name and it took me months to find you again. So don't be in that spot. And then last but not least, follow us in the land of Twitter. Oh, and you know what? There is a survey in the chat. And if Connie, if you would repost that one last time. So here's my last ask. If you click on that survey, there are only 2 questions. And you rank it from 1, which was, this was horrible, I'm never coming again, to 10, I loved it. And I'm never going to miss another one, and everything in between. And then, I'll answer just a couple of questions at the end. And, then there are comments. So let me know, did you like the pace? Did you like the topic? Are there other topics you'd like me to cover? This is your chance to have a voice. Connie just reposted that. So thank you for that. Thanks for, you guys were so great in the chat, posing lots of questions. Somebody is asking if I could share my setup. All those mini sessions cover how I set up my watch list, how I set up my charts. I'm going to do one on how I set up the option chain. So I have done that in these little 10-minute mini sessions. And the first one I did was on how I set up my my chart, my screen. So yes, I think Connie has done stuff on trailing stops, but we'll look at adding that to our mini session collection. I'll make a note on that. So guys, thank you for joining us today. I hope you found this helpful and informative. Thank you so much in advance for hitting the like and subscribe buttons. Have a really awesome long weekend. Don't forget to get out there and hug someone you love. Take care, everyone. Bye for now.